meantime, our next guest is going to talk to us about the markets, his expectations for the Fed this week. I want to bring in Joe Amato, as President and Chief Investment Officer of Neuberger Berman. He's got $474 billion in assets under management. I don't want to undercount there. Right? What are you expecting the Fed to say this week?
Well, I think the Fed's got to thread the needle pretty carefully because clearly they need to move more hawkish given the inflation readings we've seen over the course of the past several months. That's clear. At the same time, the question is, do they maintain the easing bias? That's our sense, is they'll maintain that easing bias. And then the big question is, do they take rate cuts or put rate cuts back on the table? And that would, I think, cause the market to reassess what the Fed's mindset is, and I think you'll see some additional volatility if the Fed raises that possibility.
So what kind of language should we be looking for? Because we're not going to really be looking for actually any moves.
Yeah, it's all going to be in the statement. So, again, I think being able to craft that statement to thread the needle is my guess is. My sense is he'll probably reiterate what he talked about several weeks ago, right? Right. Clearly saying inflation is an issue, but we haven't maintained.
What is your best guess? When your clients call you and say, what's going to happen to interest rates by the end of the year, you tell them what?
We think they're going to cut a couple of times, and I think the bias is lower. Yeah, we think that inflation direction of travel is still lower. Yes, there's been clearly stickier readings over the course of the past couple of months, particularly in areas that are more susceptible to labor wage increases. And housing's been a challenge. But some of those are, I hate to use the term transitory, but some of those I think will come down over time, and I think that leads to a bias lower. Do you disagree with the sort of Jamie Dimon view that actually things are going to be tougher for longer, and you might even, by the way, need rate hikes? I think
sort of a stagflation story.
I think rates will most likely be higher for a longer period of time. That doesn't mean that the policy rate's going to stay at 5 and 5.5%. We do think the 10-year represents fair value right now, looking at our long-term inflation expectations and where we think real rates are going to be. But I think rates are going to be higher than people thought 6 months ago.
If you're right, what do you think about equities right now?
Well, I think you're going to continue to see the dispersion that we've seen. I think rates higher for longer are going to put more pressure on the lower end and smaller companies. So right now, if you think about first quarter earnings, you have lots of different trends underlying. You've got technology companies, which represent 40% of the S&P 500, up 30%. You've got everything else down 5, right? But then you look at small caps. Small caps are going to be expected to be down 20% in earnings in the first quarter, on top of down 13 in the fourth quarter. So you're seeing that pressure from higher rates affect those smaller companies, where those large cap S&P 500 companies, pristine balance sheets, super high quality, globally competitive companies are doing very well in this environment.